Hugh Hendry is here with us. Hugh is CIO and partner at Eclectica. Good morning to you, Hugh. Carl Weinberg, our guest host this morning. Carl is chief economist at High Frequency Economics. Hugh, what are you doing with your money at the moment?
I'm not doing a lot, Jeff. We flicked into a new calendar year, and I'm just taking my time. The people who tell you they know what's going to happen in the next 12 months are either foolish or they're liars. I have no idea, but I'm going to be flexible in mind, and I'm going to be flexible with my portfolio.
You'll have heard, as we do every day, a whole host of strategists telling you that corporate credit is the place that you should be moving to. It has a quality profile, and in the current environment, it looks cheap. What is your view on the attractiveness of buying single A or triple A, I suppose, if you can find it a good price, corporate credit now?
I don't like strategists, right? These are the same guys who recommended everything which was a disaster last year. So, caveat emptor. That said, there's a degree of truth in what they say, but it's more complicated. It may well be that corporate debt is cheap, but not in an absolute sense, but just cheap relative to the corresponding equity class. So we began this year with the steel company in Europe, ArcelorMittal, with the 5-year paper with a 16% running yield. Now, that is cheap relative to the equity. But my point to you is, one of them is not right. It may well be that the bonds are priced properly to reflect the degree of significant economic risk, and that the equity is completely wrong. That would be, I guess, that would be my hunch.
What about, I don't know anything, I'm not a strategist, I'm just an economist, but it seems... It seems to me that, that disinflation, all right, is the theme for the first half of 2009 from an economic point of view. You can guess about the economy. We know it's going to be bad. We don't know how bad. But one thing for sure, the drop that we've seen already in oil prices imposes this miasma of disinflation, all right, upon the world, the expectation. And it seems to me that has to mean something for bonds. Again, I don't know anything, all right, but I'm just guessing. Your view?
Yeah, I think it has very positive implications for government bonds. Yeah, the price-earnings ratios, the government bond yield, the corporate bond yields. What they're telling us is that it is ferociously dangerous outside in the real world. Businesses are failing. Wealth is being destroyed. And yet, it's like Warren Buffett's. I've told this story a million times. The wildcatter dies, the oil tycoon dies. He's at the gates of heaven, and St. Peter says, I don't know what's been going on, but I'm up to here with the oil guys. The oil section is full. You can't get in. I'm afraid it's purgatory for you. And he says, listen, please, can I just one word to my old class? By all means. And he shouts, oil found in hell. And of course there's a stampede. The wildcatters go to hell. And St. Peter says, my goodness, I applaud that you're smart, and you may as well come in. And of course he turns around and he says, there just might be some truth in that rumor. That's where we are. People have lost lots of money, but the calendar clicks. It's the new year. It's a new opportunity, and they're willing to rush again back into hell.
And in that vein, I have a strategy note in front of me from one of the decent-sized houses now that says we expect gains for global equities in 2009 of 25%, but a 21% drop in earnings. That implies the global multiple will expand from just less than 11 times to a typical 17 times by year-end. Does that kind of language inflame you further? The fact that they say that the earnings have got to fall so aggressively, but we're going to get a 25% rally?
Steve, I promise you that the people who are responsible for that note, the only thing that keeps me going is the knowledge that they have no long-term career in my business. They will have to find a skill set which is applicable to their brain, because those comments are just wrong.
What do you think about some of the deals that are being made at the moment? And I'm thinking in particular about some of the bigger ones, like the reports that Citigroup and Morgan Stanley could be looking to merge their retail businesses and create a huge powerhouse. And Martin was making the point earlier on that it's cheaper to take over some of these assets now than it is to start new businesses.
There are no substantive deals going on. Business has stopped. There is no visibility with regard to the future. There is no credit or bank lending available to facilitate such deals. The Morgan Stanley Citigroup is a big yawn. It is two businesses which are failing at the present time and whose future prospects, given the industry they serve, have witnessed a profound cyclical, indeed generational high. And the best guess of most people with a heartbeat and some common sense would suggest it's uphill sledding for at least the next 10 years for such entities. So again, I've got a lot of free time on my hands because deals such as that are boring. My interest is trying to find an opportune moment to buy government bonds in some size again. And I may have missed that in the week that's just passed, because the bonds, of course, have rallied again. So the bonds for about 6 weeks have been trading an overbought condition. These strategists will tell you that government bond yields where they are today are absurd, and that they can tell you that in the next 30 years you're guaranteed to lose money. I don't care about the next 30 years, I'm more intrigued about the next 30 months. And given the circumstances, I still think it's the only game in town. But it requires the advantageous use of timing in terms of eking out a superior return.
When you turn around and see events like last week, and I have a guest on telling me there's lack of liquidity across the whole spectrum of German government bond market, plus you see very disappointing results from a Bund auction as well, does that fill you with joy, the fact that it gives you another opportunity to get back in?
It absolutely does, because by far, I think the best, here am I now, pontificating and providing you with my intellectual prejudice. My intellectual prejudice is the most attractive asset that I can find is 30-year government bonds. And the 30-year government bonds, I think between Tuesday and Wednesday of last week, dropped 6%. 6%. So that's quite a big deal if you had a leveraged portfolio. And it did provide an opportunity. We did buy more. My enthusiasm for Germany is that the euro faces an uphill task. A, they seem desperate to shoot themselves in their foot with regard to monetary policy. And secondly, the euro is a flawed mechanism. We need flexibility given the uncertainty and given the problems that we're confronted with. And the euro has no flexibility. We need drachmas. We need lira. We need pesetas. And we don't have them. And that spells trouble.
I'm delighted to hear what you're saying, because I thought my colleague Ian Shepherdson was the most bearish person on the U.S. and world economy, and you've gone a step even further. But in the world where perceptions are more important than realities, all right, if everyone agrees with you, and I think a lot of people do, that there's an awful amount of risk out there, all right, doesn't this blow corporate spreads out as wide as they can possibly go? And isn't there some angle to thinking that the market has already priced in the end of the world, so therefore anything other than the end of the world is a buying opportunity, and if the world does end, who cares, it's over anyhow?
Yeah, I still think that's back to the snake oil salesman, and it's up there with there's lots of money sitting on the sideline, and just wait, because it's all going to come back, right? No, there's not, right? There's no money waiting on the sideline. We've had one of the most profound periods of wealth destruction in the last 12 months. Heavens, we've got billionaires, people ranking us amongst the richest in the world, and they're throwing themselves in front of trains, okay? It is a myth, okay? Could spreads blow out? Of course they can. They continue to blow out. But we are in an environment which I believe we've seen debt of all forms and owned by either government or the household has gone from a cyclical and generational low in 1974 of what, about 110% of GDP, and in 12 months ago we'd volunteered to take it to about what, 340, 360%. We had supersized everything, and that's complete. And we'll find that in 25 years' time it'll be about 110% again. And that has a profound implication on valuations, on asset classes, and it puts a dampener on everything.
We'll be back with more from